smart money is on budget. Reward yourself with free rentals and upgrades. Ask about the new Budget Awards Plus frequent renter program. The smart money is on budget.
Investors, let Value Line help you pinpoint stocks that could score big price gains. We'll rush you, as a bonus, our new ranks of 1,700 stocks for price performance in the next 12 months. We expect the 100 top-ranked stocks to outperform all the rest, but avoid the 400 lowest. Value Line has ranked stocks this way for over a quarter of a century with these powerful results. And here's a second great bonus. Value Line's current full-page reports on 1,700 stocks, each with up to 15 years of statistics, fully indexed for you in this giant reference set. Your reference will be constantly updated with more than 100 new stock reports sent to you each week. To get this reference set and new performance ranks as instant bonuses, try Value Line for 10 weeks, now only $55. Call 800-535-2947 now and also receive Barron's Dictionary of Finance and Investment Terms as an extra bonus. 800-535-2947. Call now.
This opening portion of Market Wrap is sponsored by the Travelers. You're better off under the umbrella.
Good afternoon, everybody. Welcome to the Tuesday edition of Market Wrap. I'm Bill Griffith.
And I'm Neil Cavuto. Here's what was going on today. Well, did they or didn't they? Market's still abuzz as to whether the Federal Reserve policymakers meeting in Washington today opted to lower interest rates yet again to stimulate the economy. So far, no signs, but most analysts queried by CNBC through today say it's just a matter of time before rates do indeed slide one more time. Among those betting on a rate cut, Tony Ludovici of Tucker Anthony, who argues that welcome as it might be, it means little without a corresponding cut in German interest rates. Kevin Flanagan over at Dean Ritter Reynolds, who was telling me yesterday that the Fed has to address some depressing economic stats. Alan Ackerman of Rich & Company, who says that German intransigence on rates will eventually re-roil European markets, not to mention our own. Marshall Acuff of Smith Barney, who notes that a lack of growth in world economies will dictate a global trend down in rates. But one for the no-easing camp. Erwin Kellner, chief economist at Chemical Bank, argues the employment data came in better than expected and doesn't warrant a cut in interest rates just yet. Bill Sullivan of Dean Witter says that the markets might take a few days to digest that question.
The fact that we don't get anything today doesn't rule out a discount rate cut. If we don't get a discount rate cut, we may see renewed weakness in stock prices, and to some extent the bond market would back and fill the somewhat higher yields. It would be some disappointment, the fact that the Fed doesn't operate here to support the economy.
The stock market went from yesterday's wild ride to a somewhat sedate session today as investors waited for signs of a potential Fed easing. Bargain hunters were in evidence for most of the day following yesterday's downturn. We saw a little selling on the blue chips late this afternoon, not by much though. Here are the unofficial closing numbers. The Dow Industrial is down about 4 points, and then it came back just a bit on the close here. We're around the 31.78 level on the close here. The transports had a good day. The airlines going higher with the increases in airfares being matched across the board. The transports up 13.5 points, and the Dow Utilities average was up 0.19 at 216.01. On the New York Stock Exchange, the advances led the declines by a 10-7 margin. 563 issues were unchanged, and the broader market averages. Standard & Poor's 500 index was down about 0.5 point, but the American Exchange Index showed more than a gain of a point, and the NASDAQ Composite was up 5.40 at 570.61.
The lack of any clear signals from the Federal Reserve elicited a very clear response from the bond market. Prices were lower after it became apparent that no discount rate cut was forthcoming, at least not today. But that doesn't mean that the bond pits are devoid of easing expectations. Many traders still predicting some sort of move once the Fed's Open Market Committee completes that current meeting, which, as we understand, might in fact still be going on. Whatever the case, down 3/4 of a point on the long bond today at 98 2/32, with the yield at 7.41%.
Corporate news, Marriott Corporation, the day's most active issue on the New York Stock Exchange. It closed down 1/4 point at 19. Yesterday, the stock moved higher on news that the hotel operator would split into 2 separate companies. The lodging operation would be spun off into a nearly debt-free operation, while the food services division would carry most of Marriott's $2.9 billion in debt. Meanwhile, Citicorp was also high on the big board active list today. It finished the session down 7/8 at 14 5/8. Yesterday, after the closing bell, they announced the resignation of President Richard Braddock and also said that its third quarter earnings would come in below expectations. Former Citicorp CEO Walter Wriston said that, however, the bank is in a much better position than its competitors to weather any storms.
It has well-established marketplace in over 100 countries. There's no other institution in the world that has that franchise. And in fact, most of them are withdrawing from it.
Mr. Wriston was on CNBC's Inside Opinion with Ron Insana this afternoon. Elsewhere, Delta Airlines today was up 1 5/8 among those transport components I talked about. The airline says revenue passenger miles in September were up 30% from year-ago levels. And Pfizer was down $2 today. Mabin Securities cut its 1993 earnings estimates for the pharmaceutical concern, although it does continue to maintain a buy rating.
Well, our next guest believes that the slowing economy will benefit growth stocks to the detriment of more cyclical issues. Joining us now from our Wall Street Bureau, Ronald Hill, investment strategist over at Brown Brothers Harriman. Ron, how are you, sir?
Very well, thanks. And yourself, Neil?
Good, sir. Let me get your take, first of all, on the relative calm after the storm. We seem to kind of hold our own today, despite what were wild cross currents yesterday.
Right. Well, my colleague Charles Blood is fond of saying trading ranges involve months of boredom and hours of terror. We had the hours of terror on Monday, and today we're sort of back to boredom here. I mean, the market plus 11, minus 11, essentially flat at the close. You were waiting for something to act on. Obviously, the Federal Reserve hasn't given us anything today. If they don't give us anything tomorrow, we don't expect that there will be a cut until after the election. We do still think there's room to cut and probably a need to cut, but then again, if it comes after the election, you know, you're left waiting for that to happen.
You know, I spoke with an analyst not too long ago, Ron, who said, even if we do get a cut in rates, some of that has been so well priced into both the bond and stock market that when it does materialize, you might not see a reaction, especially if it materializes without a corresponding cut in German and or Japanese rates. What do you make of that?
Well, obviously what you really want, especially to kickstart the cyclicals, would be a much better growth outlook in Europe and our other export areas, because we export a great number of our sort of machinery and items like that, which is now currently lagging. Also, you're seeing a breakdown in prices in the Journal of Commerce Commodity Index, so industrial materials prices are going down. That's hurting your commodity materials producers. So yes, what you'd really love to see is better growth globally. What you need, though, I think, for the stocks is to have short-term interest rates come down yet further, takes away the competition from cash, so the money will again continue to flow more towards bond and stock funds simply because the returns aren't there for cash. And that would be a positive for the market.
Ron, what do you like these days, this environment?
Well, essentially, you know, we think that you got to factor in somewhat the election results. Whatever happens, you're probably going to be looking at some kind of stimulus here, which will be especially good for the middle-income consumer. So I think that these middle-income retailers like the May department stores, the Kmart, the Toys R Us, and the Walmart stores will probably still be very attractive here. And again, on the growth side, as you know, we like Philip Morris, PepsiCo, and some of the food companies, especially General Mills, which has been lagging in here, and Heinz. But the drug companies, alas, probably have to wait at least until after the election to see what the initiatives are going to look like on the legislative front.
Now, I notice you mention names like Coke and Philip Morris, and I'll throw in a name like Merck. All companies that with big foreign operations whose earnings might in fact be imperiled by slow European growth. What do you make of that?
Well, but again, you know, the flip side of that, of course, is that the translation affects the weak dollar versus the stronger European currencies.
Good point.
The companies that have this big growth here, they're able basically to manage those earnings pretty well. And if earnings look a little too strong, they'll take extra reserves or they'll increase marketing expenses. If earnings are looking weak, what they'll do is cut back on marketing expenses. So again, you know, well-managed growth companies have a lot of flexibility with earnings, and so they tend not to surprise you in a big negative way.
All right, I don't ask you to necessarily don a technician's cap here, but at 31.78 or about that level, is there another level at which we sort of are looking at as a technical support for this market, or something that would worry you if we start getting near it?
Well, I tell you, the possibility if the Fed doesn't move and people get a little more, you know, down in the mouth about the near-term outlook for equities could result in a sort of a lower volume test of those lows we saw on Monday, which takes you around 3,100 on the Dow, just below 400 on the S&P 500. I would hope not to break those levels. Breaking those would send a different kind of signal. If we maintain those levels, we're still in the trading range, still looking eventually to move back up towards the top of that range at some point, I think.
All right, Ron Hill, it's always a pleasure.
Thank you,
Ronald
Neil.
Hill is the investment strategist, by the way, over at Brown Brothers Harriman.
When we come back here, our Jerry Cobb reports on California's insurance woes and the somewhat downbeat aftermath of the state's groundbreaking Proposition 103. Market Wrap continues in just a moment.
Today's Market Wrap, sponsored by GE. At GE, we bring good things to life.
This is the hand that turned on the light, that lit up the desk where the idea was born for a quieter jet engine that flew the technician who works at the power plant, which produces its energy far more efficiently as it lights up the city and powers the hospital with its life-saving images, where Sam was found healthy, in time for the game, held under the lights and broadcast to millions by a satellite system, designed with precision and shipped by powerful locomotives that passed by a factory that helped build a car with advanced thermoplastics that sits in the drive at the home of Patricia, who went to the fridge and got a drink for her dad, who works in the room where he turns out the light as he puts his young daughter to bed.
Every day, GE technology touches the lives of just about everybody.
There's something you should know that no broker is going to tell you. You can use dividend reinvestment plans to invest directly in companies and bypass brokers entirely. I'm not telling you this so you can avoid broker's commission. It's just so you'll know that even a small investor can have a diversified portfolio. You can invest in companies from Abbott Labs to Zurn, and every penny will go toward buying stock. You are the only one to benefit from your investment.
Call now. Finally available under one cover, every company with a dividend reinvestment plan and everything you need to get started investing. All for only $9. Plus you get a free copy of The Money Paper, the monthly guide for the self-reliant investor.
Remember, it's easy to buy stock without using a stockbroker.
Call 800-443-6900 with your Visa or MasterCard handy. This information-packed sourcebook could save you thousands in broker's commissions and improve your investment results.
Join CNBC anchors Karen Gibbs and Ron Insana in Chicago for the CNBC ISI Investors Workshop being held October 10th. Spend an exciting day discovering the latest investment trends and the most profitable products and services of today and tomorrow. Plus, get expert money-making advice from top investment pros, including Ned Davis, Raymond Merriman, Peter DeSario, Bernard Schaefer, Jacob Bernstein, and Craig Corcoran. Fine-tune your portfolio with America's most sought-after investment experts. Call and register today.
Welcome back, everyone. Before we take a look at the rest of the day's news, let's see how these major market numbers are settling out. What a difference a day makes. Not much of whipsawing here. We're down about a point at 3178.19. Still, over the last few trading days here, you're looking at about a 76-point drubbing of the Dow. The transport's up about 14 at 1254.21, while the utilities turn things around, back up to 216.14, a third of a point gain today.
The Federal Aviation Administration is stepping up its inspection of U.S. Air's maintenance operations to ensure flying safety. U.S. Air was struck yesterday for the first time in its 13-year history, the walkout involving 8,300 machinist union members. Meantime, flight attendants who walked off the job yesterday in sympathy are abiding a back-to-work order at this point from the courts. The carrier was turned to its management corps to perform maintenance repair operations in the meantime. So U.S. Air is up 5/8 today at 11 7/8. Meantime, it is doubtful that bankrupt Continental Airlines ever thought it would be this popular among investors, but Aeromexico has now joined a group led by investor Charles Hurwitz to put forth an improved $400 million offer for Continental, and a group led by Air Canada has improved its bid by $25 million to $425 million. In addition, LA investor Marvin Davis and the German airline Lufthansa have asked for more time to revise their $400 million bids. All this continues a whirlwind week for Continental. Yesterday, Scandinavian Air announced it had joined forces with Houston Air in its effort to buy the airline. A bankruptcy court has given Continental until November 16th to file a reorganization plan.
Senator Alphonse D'Amato is nursing a sore throat today after a marathon filibuster attempting to change the $28 billion tax bill. The Republican from New York began speaking at 9:30 Eastern Time last night and continued until midday today. D'Amato was trying to get the state and the Senate there to amend the bill, claiming that his changes would save jobs at the Smith Corona plant in upstate New York. But House Majority Leader Richard Gephardt countered, saying there was no way that the House would alter the bill, no matter how long D'Amato carried on. Democratic presidential contender Bill Clinton has the upper hand on Electoral College votes just 4 weeks before the general election. The latest tally from Singlinger & Company of Wallingford, Pennsylvania, shows Clinton leading with 291 electoral votes versus just 91 for President Bush. 141 remain undecided. You need 270 to win.
You know, Californians had high hopes for Proposition 103 when it passed 4 years ago, but so far it has produced more lawsuits than insurance premium reductions. Jerry Cobb has the follow-up now from L.A.
The auto insurance revolt that began in California has hit a roadblock. Instead of rolling back rates and giving refunds to the state's 13 million drivers, the landmark Proposition 103 remains in judicial gridlock, leaving the insurance industry in a stall.
We don't have a very active marketplace. In fact, we have a marketplace that's basically being held hostage to this issue of rollbacks that would amount to no more than $100 per driver in the state of California on a one-time basis.
Only a handful of insurers have refunded a fraction of the $2.5 billion in rollbacks ordered under Prop 103. Many are challenging the measure in court, locked in a bitter fight with Insurance Commissioner John Garamendi. He's imposed a virtual freeze on new business pending the resolution of Prop 103. And that's especially painful to carriers that suffered losses in the LA riots and the recent hurricanes.
The industry can't take these kinds of hits against their surplus too much longer without having that impact show up in the necessity to raise rates. And in this hostile regulatory environment in California, I think we're gonna start seeing some sparks fly.
About 60 insurers have found it so hostile here they've packed up and left the state. Many say others could follow. Meanwhile, California's auto insurance rates continue to be high and are at least partly responsible for the precipitous drop in younger drivers here. 10 years ago, roughly 3 in 5 California teens old enough to drive had their license. Today, only half do.
I think that they should reduce insurance costs and include some of it in taxes. We pay a lot of taxes, and that would help us out, you know.
Many in this classroom plan to wait until they're 18 before getting their license.
Because it's a lot cheaper that way, and that way I don't have to pay for the classes, and I can just go to the DMV and it's done.
How many of you know somebody your age who's driving illegally without their license? Harvey Rosenfield, the consumer advocate who spearheaded Proposition 103, remains confident the insurance revolution will go forward, despite the industry's resistance.
Okay, we'll have Hillary Johnson more after this.
Investors. Let Value Line help you pinpoint stocks that could score big price gains. We'll rush you, as a bonus, our new ranks of 1,700 stocks for price performance in the next 12 months. We expect the 100 top-ranked stocks to outperform all the rest, but avoid the 400 lowest. Value Line has ranked stocks this way for over a quarter of a century with these powerful results. And here's a second great bonus. Value Line's current full-page reports on 1,700 stocks, each with up to 15 years of statistics, fully indexed for you in this giant reference set. Your reference will be constantly updated with more than 100 new stocks.